Hello friends, today we're diving deep into the world of private equity, and boy, it's a roller coaster. With all the ups and the downs in the economy this year, you'd think that it would be a tough time for companies like Blackstone, a big shot in the private equity world. But guess what? They've actually been doing pretty darn well, and we're here to figure out how. Now, one thing that's really caught our attention is how Blackstone's money pot, officially known as assets under management or AUM for short, just keeps on growing even when interest rates are climbing up. Most folks would think that high interest rates would scare off investors and make their AUM shrink, but not for Blackstone. Now, they've turned the tables and reported a whopping increase. That's like going against gravity, and it definitely makes us want to take a closer look. So let's talk numbers. When we play detective and do some simple math that's dividing how much the company is worth by their AUM, Blackstone starts to look like a pretty sweet deal. The ratio we get is 11%, which sits comfortably between 8% and 20%, a range they've been in before. If you're kind of like an optimist about where private equity is headed, this might just be your cup of tea. But hold on, we can't just ignore the elephant in the room, the rising interest rates. Some folks are actually worried this could be a party pooper for private equity. Big investors might ditch it for safer and more straightforward returns they get from short-term rates, and the industry might just find itself in a bit of a pickle with all the pressure on valuations. Despite all this, Blackstone's AUM just keeps on climbing, making us scratch our heads and wonder, is this private equity really cool as it seems? Can it really swerve through all its economic craziness and come out on top? Well folks, Blackstone is certainly making a case for it, and it's got our fullest attention. We've now got a paradox on our hands, and it's all about money flowing in and out of the industry. Have you ever looked at a chart and thought, what on earth is going on here? Well, that's exactly what the Bloomberg Private Equity Chart book had us saying. It's like a treasure trove of industry secrets, and we've got the key. Let's rewind back to 2017, a golden year for private equity with cash pouring in like never before. Fast forward to 2022, and suddenly we're seeing a 50% drop in that flow. Interest rates were climbing, and the private equity world felt the chill. Now we're in 2023, and the trend continues with the projections hitting a low of just $28.4 billion in new commitments. For those betting against private equity, it seems like a sure win. But wait, here's the twist. While the overall trend is on a downsizing, some funds, and we're talking about big names like Blackstone, are closing gigantic deals to the tune of $30 billion. And they're not just alone, there's a whole club of mega funds raking in over $144 billion in just 3 months. So what gives? How do we make sense of the Bloomberg data showing a downward trend while big funds are partying like it's 2017? It's a puzzle, a conundrum, a real head scratcher, and it leaves us with one big question. What's the future of private equity in this roller coaster market? Stick around and we'll unravel this big mystery together. In this part of our journey, let's dive deep into Blackstone's real estate empire, shining a spotlight on their 10th Real Estate Partners Fund. Remarkably, this fund just clinched a whopping $30 billion at its recent closure. Think of it like a blockbuster movie series, where one hit leads to the next, and that's how Blackstone runs these funds. Their strategy is very simple. It's a well-oiled machine. Profits from one fund flow right down to the next, creating a never-ending loop of investment possibilities. Investors love it because they get regular chances to take their money, think things over, and jump back with a new strategy. Blackstone loves it because it keeps the fees rolling with each new fund. As long as real estate prices keep climbing, the assets under management just gets bigger and bigger, like a snowball rolling downhill. But here's the twist. Even though we're seeing fewer dollars pouring into private equity overall, as long as Blackstone's funds keeps performing like rock stars, they should see their AUM grow. But it does beg the question, how much of this is really new money? There's a hint of a lag, a slight delay in the cash flow into Blackstone, raising a red flag. If these high interest rates stick around too long, we might actually see a dip in their AUM. This lag is crucial. It could be showing us the time it takes for a successful fund to wrap up and for that money to get pumped into the next big hit. It's a critical piece of Blackstone's strategy, and it could have big implications if we find ourselves in a world of persistently high interest rates. Now, let's zoom in on the fascinating financial world of Blackstone. As we sift through their latest quarterly figures, a startling contrast comes to light. There's a wide gap between the total assets under management, which hits the $1 trillion mark, and the assets that they're actually bringing in fees, standing in at $731 billion. This is where real estate steals the spotlight, playing a pivotal role in raking in those fees. Breaking it down, Blackstone's assets are pretty evenly distributed across real estate, private equity, and credit. But here's the twist. Even though real estate has more assets churning out fees, it generates almost the same, if not less revenue compared to private equity. This leaves us scratching our heads, pondering, does this mean the fees in private equity are substantially juicier? Blackstone's strategic play with perpetual capital has nudged them more and more towards real estate. A sizable chunk of their assets is wrapped up in their property ventures like the Blackstone Property Platform, the mighty Blackstone Real Estate Income Trust, and the Blackstone Infrastructure Partners. Now, even when their infrastructure arm has taken a 16% hit this year, the Real Estate Income Trust stands tall with a staggering $68 billion in assets, potentially crowning it as one of the world's behemoth REITs. But why this sudden allure towards REITs? What's in it for Blackstone? Let's unravel this mystery. A peek into B-REIT, or Blackstone REIT's fact sheet, lays it all bare. Blackstone has cleverly tweaked the game here. They're charging a whopping 12.5% performance fees on annual returns that soar above 5%. That's like they found a way to have their cake and eat it too. By taking listed REITs private, they've opened up a pathway to impose higher fees, all while promising the sweet allure of less market volatility in valuations. Yet, despite this bustling AUM growth and their bold moves in the REIT domain, there are murmurs of concern. B-REIT in particular has hit a bit of a turbulence, facing a wave of redemption, resulting in gating. This stands in stark contrast to the steadier waters that listed apartment REITs are sailing in. It leaves us pondering, how sustainable are these lofty valuations? How long can this low financial pressure last? In a nutshell, Blackstone's playbook revolves around this genius rollover of funds, sky-high fees in private equity, and a powerful gravitation towards real estate. But as we stand back and take it all in, there are shadows of uncertainty, questions about transparency, the durability of property partnerships, and the unique challenges in the world of REITs. They all linger, leaving us wonder about the long-term game plan and the level of trust investors can truly place in these assets. In this part, we're diving deep into Blackstone's remarkable growth. Even as the private equity world slows down, while money flowing into this sector might be taking a backseat, according to Bloomberg, Blackstone stands tall, with its AUM on the rise and its shares holding strong. So what's the secret sauce here? A lot of it has to do with the solid real estate market and the skyrocketing US house prices providing a sturdy backdrop. Blackstone is playing its card right, tapping into the value of rising collateral, which acts like a safety net, even as interest rates climb. The strategy seems to hinge on the long-term financing, where they're less affected by interest rate jitters and more focused on asset appreciation. This implies that Blackstone's funds are in good shape, ready to withstand market shifts, and even in a sell-off situation, they've got valuable assets to bank on. Yet, we can't ignore the broader economic landscape. Interest rates, especially in the US, are heading upwards, aiming to cool down the hot property market and bringing some balance. This surge in interest rates is expected to stick around until there's a notable impact on property prices, possibly ushering a period of deflation in collateral values. Now, if we turn our gaze to China, it's a different story. These property prices are dipping and interest rates are going down, setting a deflationary scene. This contrast sheds light on the crucial insight. Interest rates might only start to retreat when there's a clear drop in collateral values. For Blackstone, this could translate into a delayed adjustment phase where they need to catch up with the market shift experienced by publicly traded assets. Bringing all these threads together, it paints a complex future for Blackstone. The company has flourished in a low interest rate world, but seems to be missing a backup plan for a potential drop in property collateral values. If interest rates keep climbing, or if collateral values stumble, Blackstone might find itself on a shaky ground, turning it into a prime target for investors looking to bet against it. In today's comprehensive exploration, we've delved deep into Blackstone's intriguing journey amidst rising interest rates and market fluctuations. Blackstone stands out in the private equity world, demonstrating the resilience with continuous growth in assets under management, despite the economic uncertainties and a general decline in the sector. Their secret? A strategic emphasis on real estate and perpetual funding, creating a robust cycle of investment opportunities. However, the disparities between total assets and fee-generating assets, coupled with the high fees in private equity, leaves us pondering on the sustainability and transparency of their model. As the market shifts and interest rates continue to climb, Blackstone's ability to navigate the changing tides, especially with potential challenges in collateral values, remain a focal point of interest. Today, we've unraveled the layers, but the future holds the answers to Blackstone's resilience and adaptability in this financial roller coaster. Alright friends, we've explored Blackstone's financial journey today, and now we want to hear from you. Share your thoughts and predictions in the comment section below to add to our collective understanding. If you've enjoyed this video, give it a like and share it, and make sure to subscribe and ring the bell for more insights, adventures in finance. Stay curious, stay savvy, and we'll meet you in the next video. Bye for now.